Many people confuse the terms retirement annuity funds and retirement funds. While retirement annuity funds are a specific type of retirement fund, the collective name for pension funds, retirement annuity funds, and provident funds is retirement funds. In December 2015, Treasury announced a host of new laws regarding retirement funds, and all of these laws were supposed to come into effect together on 1st of March 2016. Some of these laws did come into effect on 1st of March 2016, but the trade unions have forced the government to postpone parts of new legislation. What will happen from 1st of March 2016 is that contributions paid by the employer and the employee to pension, provident and RA funds will be tax deductible by the employee. While only contributions paid by the employer will be taxable in the hands of the employee, both employer and employee's contributions may be tax deductible. Formulas will determine exactly how much of the total contributions will qualify for a deduction. Taxpayers will enjoy tax relief on contributions to provident funds made after 1st of March 2016, in addition to the tax relief on contributions to pension and RA funds, and it works like this. From 1st of March 2016, all contributions to pension, RA and provident funds will effectively be grouped together as retirement fund contributions, and all these contributions together may be used to determine a deduction against taxable income. The deduction amount that may be used by the employer at salary source when determining pay as you earn is the lesser between the total contributions and 27.5% of remuneration, and limited to 350,000 Rand per year. However, the deduction amount allowed on the annual tax assessment will be the amount of the contributions limited by the greater between 27.5% of taxable income or 27.5% of remuneration. The amount allowed as a deduction may not exceed 350,000 Rand a year. This means that the old RA 15% and pension 7.5% contribution deduction limits fall away and are replaced by this new rule, which is effectively a 27.5% rule with a 350,000 Rand a year limit. The 27.5% rule will also apply to government employees contributing to the Government Employees Pension Fund. The new laws will benefit many lower income and middle income taxpayers contributing to retirement funds by allowing a greater deduction for increased contributions, but the limit that has been introduced will not be kind to high income earners who make large contributions to retirement funds. For example, a taxpayer who earned 3 million Rand a year with no deductions and contributed 450,000 Rand a year to an RA in the past would have been allowed to claim the full 450,000 Rand as a deduction against taxable income, 450,000 being 15% of the 3 million Rand taxable income. The new laws will cap the deduction allowed at 350,000 Rand a year, and this will mean that higher income taxpayers in this situation could pay thousands more every month in extra tax. Nothing has changed with regard to how lump sum amounts received from these funds are taxed when the lump sums are taken. The parts of the new legislation that the unions forced the government to postpone to 2018 were the proposed annuitizing of portions of lump sums from provident funds at retirement. The government wanted amounts in provident funds treated in the same way that pension funds and retirement annuity fund amounts are treated when the fund member retires. In other words, the government wanted provident funds to only allow a maximum of 1/3 of the amount to be taken as a lump sum at retirement and the rest placed into an annuity to provide a regular income. Due to trade union objections, this was sent back for review until 2018. Members of Provident funds may continue to take all of their money in the fund as a lump sum at retirement. One more change concerns the amount in a pension or RA fund available to the members at retirement. If the member's amount in the pension or RA fund is less than 247,500 Rand at retirement, then the member may take the full amount of the money in the fund as a lump sum. If the member's amount in the pension or RA fund is more than 247,500 Rand, then the pension fund or RA fund member may take only 1/3 of the money in the fund, and the other 2/3 has to be placed into an annuity at retirement to provide a regular pension. I repeat that this does not affect Provident funds, where the member may still take all his money in the Provident fund as a lump sum at retirement and then pay tax on the lump sum as per SARS's tiered tax tables.